Hello everyone, welcome to Voice Behind the Keys. My name is Wilson and sitting beside me is CKY.
We've been in this property industry for 5 years already, so we are here to actually answer some questions from public about property investment. So if you are interested in property investment knowledge, click like and subscribe to follow more future contents about property knowledge. So let's look at some few questions. This investor asks about, he has looked at a few projects, but each also has some flaws, so how he can decide?
Actually, this is a very common situation. There's no single project is perfect. In fact, every project has its own strengths and weakness. For example, some will have better locations but smaller size, and also some will have attractive pricing but less branding. When you look at the premium condos, it might sound really attractive, but when you go to the figure, for example, the rental, it may be fluctuating and also less certain. Instead of saying which project is the best, I would say you should ask yourself which project suits you the most. For example, if you're looking for own stay, I would suggest you focus more on comfort and lifestyle. For example, let's say if you're very certain your job nature, be working from home most of the time, and you are very familiar with this area, this particular area, actually you don't have to look at the rental or anything. You just look at the project itself, whether the layout or the environment or the facilities are very convenient or comfortable for you. Whereas for investment, we need to do our research. First of all, we need to look at the demand, the nearby demand, and whether there is a target audience of tenants from different variety, for example, working adults or schools or university, so that you can tell that whether this project is worth for your investment. Because first of all, you need to have a stable rental income, and also you need to compare the prices around where it's a completed condo that's actually higher or lower market value than your current eyeing property, so that you can have an idea of whether this property is worth for your investment or not.
Then why so many property investors, they actually will end up making wrong decisions, like they actually lost money in their investment even after they do so much of research?
Well, I would say there's abundance of information scattered online and even on the broadcast or podcast as well. So actually, I believe nowadays it's too easy access to vast information. So in fact, you still can make the wrong decision is because you get lost in the midst of researching. So sometimes people not too sure about whether they want to invest or not, or they want own stake or not. They will suddenly out of nowhere, they're stuck in the middle where actually this project looks good to invest, but there's some time in the future I might own stake too. So they'll get lost in the middle that initially they are looking at the capital appreciation, the figures, and also the rental demand. Then suddenly when it comes to the layout, they feel like, it's not comfortable for me to own stay for long. And somehow what if in a later time I decided to own stay for myself? And because of this, you might choose the wrong property.
So it means that the purpose of you purchasing a property is you need to be very clear and very firm that you want to either invest or own stay.
Of course, when you are very firm that you are looking for property investment, you need to answer yourself that you are purely looking for investment or there's a mix of this. So when these questions come to an answer, then only you can further develop all the criteria in order for you to select the best property. We always look at the figure. For example, nearby rental demand, and then the rental rates, and then the occupancy. Actually, all of this information is very transparent online. It's easy to search. So where there's a figure there's a proven data shown, actually it's quite straightforward. There's a reason why sometimes you might lose some chances to get into the market where there's a pre-launch condo, where suddenly out of nowhere, all the most desired layout are sold probably within 1 day. That's happened to us before. And also there's a situation where within 1 month, then all of the whole building of the pre-launch project is already been sold. People still make mistakes because investor might not be full-time investor as well.
I see. So let's say for investment, since we're talking about pre-launching, new launch or sub-sales better?
This is a very tricky question. It depends on whether how much cash flow you have with you. But when it comes to mathematically, to judge whether pre-launch or sub-sales is better, I'll definitely go for pre-launch because you don't have any initial capital. For information, right now in the competitive market, you can tell even the government or different authorities are pushing for project launching so that they will have jobs and to help the economy. So you can see developer is giving massive discounts and rebates, and in fact you literally only need zero cost to own a property. When I'm speaking of zero cost, which means you don't have to pay anything to buy a property, especially for pre-launch. So when you don't give out anything, it means you have zero initial capital. Then you can own an asset. Basically, I would say this is a better option compared to sub-sales, because when you go into sub-sales market, you need to look at the property surrounding, and also you have to check on the value, and also you have to go through some research and also some calculation on the amount of money you have to take out. So it's very time consuming, and also you have to really have the amount of cash. Because once you go into sub-sales, you straight away will pay the full monthly installment. And how can you make sure that the monthly installment can be covered, whether or not it's for own sale investment or not? And then, yes, some might say that nearby they have a data proven that have been rented at this price to cover your installment, and even when the owner is selling the property with tenant as well. But ultimately, why is the owner willing to sell out when there's a tenant there? So there could be some hidden costs that we might not be aware. And also in the sub-sales market, you have to pay for the legal fees and also the renovation touch-up, valuation fee as well, which all these costs actually will be borne by the developer if you go straight for pre-launch project.
So speaking about this, are there any hidden costs when buying a property? Spoke about hidden costs just now.
Yeah, just like I mentioned just now, it all depends on which market you go for. It's either primary market or secondary market. So for example, if you go for a primary market, of course, it's pre-launch project. So ultimately, it's only the progressive interest that you are going to pay for it. I would say the progressive interest you can calculate as a 5% of the SPA price. So even though it sounds a lot, 5%, but actually along the time when the developer starts selling a property, since the beginning, it's actually start constructing the property as well. So it takes 4 years time to sell and to construct. During this period, actually, developer has the right to increase the price. Over the years, given my experience, I'm quite sure that the increment is definitely more than 5%. This is only the cost. It's only ultimately until the time of moving in that only you need to consider the renovation and also probably some MOT. But all this can be covered by some additional rebate or cashback by a developer during the time of launching if you are going for the right properties. So basically, these are the hidden costs, so-called hidden costs for pre-launch project. Whereas for the sub-sales, the hidden cost is a lot more. Because sometimes when you go into sub-sales viewing, you don't know whether how old is the piping or electricity, because you go for cheaper, for example, nowadays people say they can own a 500, 600 landed in KL area.
In the end, they end up paying more because of they need to rebuild the whole thing.
Yeah, exactly. So because when you go into a sub-sales, yeah, it's cheap. Yeah, it's single story or probably a double story in a KL prime location. But when you look at the details, after you're starting to move in, starting to get the drawing for architecture, when you look at the cost, it's actually a hefty amount. It's not easily 1,000 or 2,000. And it can go up to at least 300,000 to 1 million, depends on design. Even for just a kitchen alone, it actually can go up to 100 to 200k. So these are part of hidden costs we need to be aware of during the sub-sale viewing. But aside of this, the rest, not too big but also not too small, because in sub-sales you have to pay for the legal fees and loan stamp duty and etc. Which I would say in total, all this amount can cost up to 20% of your purchase price. So which means, for example, let's say if you go for a sub-sales property, you have to at least prepare, for example, a 500k property, you have to need to prepare at least 100k cash on hand, which nowadays, even 10k saving in most of the people bank account is really hard to achieve.
Buy now, pay later, got 10k debt.
Yeah. So as an investor or property owner, you really have to look into it and do the calculation yourself. So let's move to a more tricky questions. Do pre-launch properties really offer better discount, or is it just marketing?
I think it depends. So actually you need to do homework on what is the price going on that area itself. But just now, like we have mentioned in the last few questions, pre-launch usually do offer better discounts because along the 4 years of a construction period, developer will actually increase their price to match back or actually to market price on that area itself. So along the 4 years, if you bought the property at a pre-launch stage, it's definitely cheaper than you buy it at the end of the construction years. It's not only marketing, it's really better promotion stage. Most importantly, you have to do homework on what's the price going on in the area itself. So if let's say the pre-launch price is actually higher than the median price of that area already, then definitely you know that this is something not you should go on. Even it's cheaper than what it should be going on for that property itself. If let's say the developer has increased around 5% of price from the pre-launch stage to the construction phase, then your progressive interest is roughly there also. No point that you actually drag until there's no more units, you just go for it, because you can't even choose your favorite unit, favorite facing, or favorite level. But at pre-launch stage, you have all these choices at the best price. So I think for property investors, it's not about that is pre-launch cheaper than not pre-launch. It's the price, is it lower or cheaper than the median price of the area itself? So if let's say the pre-launch price is 800 per square feet, but the median price is 850 per square feet, then okay lah. But if let's say the pre-launch price is 900 per square feet, but the median price for a same layout, same level property is 850 per square feet, then it's 50 per square feet more expensive, then even if it's pre-launch, then I think it's not something that you should go for it. So it really depends.
How about the next question? It's very applicable to, I think, most all of us. So with all the war news right now happening, is it still good to invest property?
I think it's actually one of the best time. A lot of people actually fear that all the property, the fuel prices going up will affect a lot of stuff, which is true, because you see petrol prices going up, diesel prices going up, it's construction materials going up. But we have to know that at this moment, the effect of the cost has not reflected in consumer side yet. So you see food prices, you see all the property prices, it's still not significantly gone up, because the effect is only on business to business, the logistics side. So you see people still go to travel, you don't see people lose jobs because of war also, because I think everyone knows this is going to be a temporary thing. But the truth is, because all the while the fuel prices gone up already, at this period when all the logistics is going on, the cost is memang reflected on the construction cost materials itself. So I would say maybe the next 2 quarters when there are new launches, property price is definitely not the price we are going to see right now. So if you are already planning to actually purchase a property, then I think now is the best time. We don't know how long the war is going to continue. Why not, since it's not reflected yet, you still can buy property at the price when the war hasn't started. Actually, if we look back to the history, like we look at COVID affects a lot of people lose their jobs also. But property prices are the best at that time. People who bought properties during the COVID time, they earn. So actually, when there's a crisis going on, sometimes
There's a gain, there's a pain.
There's an opportunity. It's always an opportunity when there's a crisis. Who knows, if let's say you bought a property and the next 2 quarters, like really the property price gone up significantly, then you gain a lot already, rather than you just wait for a quarter. If you are already surveying, you know that you are going to buy this year, then I think this few months is actually the best time. All the launched property, they will definitely still maintain at this price until when there are new launches come up, the prices gone up already, then you will see the property prices will gone up in a significant level. The construction materials will increase already 20 to 30%, so property prices will gone up around there also.
And also, like you mentioned before, during the COVID times, that people earning a lot through property. And one of the interesting questions here is asking, is it risky to buy lelong property?
The main risk of a lelong property is you cannot actually assess what's the property condition. You don't know who is the previous owner. You won't get to access to the lelong property to actually to view, is it pretty, what's the condition, what's the reason of being lelong, who is the previous owner. So these are the homework that you have to do before you really go for the bid. Once you go for the bid and then you actually got the property, you have to pay everything already. It's not like you go for the bid, you cannot loan, like new launch, you still can loan rejection, give back your refund, your bidding deposit is 10%. If the property not nice or whatever, you still need to pay one.
Okay lah, at least worst case scenario, you just get a 10% penalty.
Yeah, 10% penalty. But who actually wants to get a 10% penalty? It's not cheap. Your 600,000 thing is already 60,000. So, but you go for new launch property, you book 1,000, don't want then cancel, then I get back my refund. So I think this is the main risk, because you have to fork out a deposit for uncertain things. So what you actually need to do is you have to check what is the other caveat. Caveat means like you have the issue of the title transfer. So if let's say it's caveat due to some reason or bankruptcy, you have to open the caveat. You have to go through a lot of hassle. And actually, you need to purchase already, you can only open caveat one. And also, all the outstanding maintenance fee, the cukai pintu, cukai tanah. If let's say the property is lelong outstanding for 10 years, that makes a big amount also. If let's say you added on all these costs that you will expect to actually pay extra, then it's your target price, then okay lah.
One last question from the audience. So whichever market the property you purchase, when is the best time to exit, like for investor?
Basically, rental is to cover most of the interest of your loan. We always say that it has to cover at least 80% of your loan installment, is because 80% is the interest. So actually, once you cover your interest already, so whatever gain is the net gain already. So of course, if you cover more, that extra is also one of your net gain. If let's say you can sell your property at a 50k extra, beyond the 80% is the extra, that goes to your net gain also. Then after your legal fee, MOT, after those selling costs, then you still net gain 50k. Then okay lah, you can sell. I think it still goes back to that principle that what's your target. It's like buying stocks. If you buy stocks, you have your take profit time, you have your stop loss time. So your principle has to be very clear. My aim is I rent out, then I get 50k capital appreciation. I sell. But if your aim is actually, I just want to take rental income, don't care about capital appreciation, then you just take the rental to cover all your loan installment, or you still pay for your loan installment.
Or maybe you pay extra.
I pay extra,
early settle.
Yes, your early settle, then whatever you sell is the complete net gain. I think it still goes back to the purpose and principle at the beginning is very important. You don't buy it because, I don't know got expect, don't know got capital appreciation or not, or I don't know got rental income or not. Then that's the risk. It's not an easy journey but I believe you will learn a lot during this process, and it's also one of the way to actually to build your passive income. So if you want to know more, like and subscribe. We will share more about this property investment content.
And feel free to drop some questions on the comment so that we can answer for you at a later time.
Bye bye.
Thank you.